Think back to yesterday. Think back to the quiet moments of the holiday season when most people were focused on family and festivities. I warned you that the calm was a lie. I told you that the global financial markets were standing in a room full of gasoline, just waiting for a single match to be struck. On the night of December 26th, 2025, that match was not just struck, it was dropped into the fuel. While the world slept, the price of silver did not just move, it teleported. We are not talking about a standard rally or a typical price increase. We are witnessing a total market dislocation. Silver gapped up nearly $4 in a single shortened holiday session, hitting a staggering high of $75.14 per ounce. The old all-time highs have not just been broken, they have been obliterated. Traders in London who went to lunch with silver at $72 returned to find their short positions liquidated at $75. This is the moment the survivors are separated from the victims. The survivors are those holding physical metal in their hands. The victims are those holding paper promises and short contracts. We have entered the acceleration phase, a period where the laws of financial gravity no longer apply. The move from $20 to $30 took months, but the move from $70 to $75 took only hours. We are now on an unstoppable wave toward $100. To understand why this happened, we must look at the structural mechanics of the market during what we call Ghost Week. This is the period between Christmas and New Year when the senior risk managers at major banks like JP Morgan are away in Aspen or the Swiss Alps. The trading desks are run by skeleton crews and the order books are historically thin. In a normal functioning market, a move of 5% in a day happens in waves. There is a constant battle between buyers and sellers that creates a zigzag pattern on the chart. But today was different. At 8:30 a.m., a buy order for only 500 contracts hit the system. In a liquid market, that would move the price by maybe 10 cents. But because the order book was empty, that order hit a vacuum. There were no sellers at 72, pay $50. There were no sellers at $73 or even 73, pay $50. The exchange matching engine had to scan all the way up to $74 just to find the first person willing to sell. This created an air pocket. Silver skipped the cents and moved in dollars. This lack of liquidity acts as an accelerant. It is like pouring gasoline on a fire that was already burning out of control. If a small amount of buying from a few hedge funds can teleport the price to $75 today, imagine what will happen on January 2nd. That is when the real institutional buying begins. The banks are trapped, the sellers have gone on strike, and the path of least resistance is now vertical. While we were watching the price hit $75 in New York, something even more significant was happening on the other side of the world. If you think $75 is the ceiling, you are looking at the wrong map. You are looking at a localized paper distortion in the United States, while the real physical market has already moved to a different zip code. The Shanghai Futures Exchange was open for its overnight session, and the numbers coming out of China are staggering. The front-month silver contract hit a high of 18,656 yuan per kilogram. When you convert that at the current exchange rate and account for the 32 Fe 15 ounces in a kilo, you are no longer looking at $75. You're looking at $83 per ounce. The United States market closed at 74 Fe $50, while the Chinese market is trading at $83. That is a premium of $8.50. In a functioning global economy, arbitrage should be instant. Banks should be buying in New York and selling in Shanghai to capture that free money, but they are not. The gap is widening. This tells us that the arbitrage mechanism has snapped. The banks can trade paper digits all day, but they physically cannot source the 1,000-ounce bars to ship to Shanghai. The inventory is gone. The logistics have failed. New York is now a lagging indicator, and Shanghai is the leading indicator. We are witnessing the divorce of the paper price and the physical price in real time. This $83 price in China is the ghost of Christmas future for the American market. It shows exactly where we are going. Math provides the fuel for this rally, but you still need a match to light the fire. This morning at 4:30 a.m. Eastern Time, that match was struck in the Caribbean. While the mainstream media was focused on holiday retail sales, the United States military escalated the trade war into something far more dangerous. United States Coast Guard Special Operations teams, supported by naval assets, forcibly boarded a crude oil tanker named the Centuries in international waters off the coast of Venezuela. The Centuries is a Panama-flagged vessel owned by a shipping conglomerate based in Hong Kong. It was carrying 8 million barrels of crude oil bound for China. This was not a routine inspection. It was a kinetic operation. The United States military just seized Chinese-owned property in international waters. This is an act of war. The response from Beijing was immediate, condemning the action as piracy. But the most important response came from the high-frequency trading algorithms. When the newswires flashed the words U.S. Coast Guard, boarded tanker, and China condemns, the algorithms switched into war mode. In war mode, you sell the currency of the aggressor and you buy the asset with no counterparty risk. That asset is silver. Gold rallied, but silver outperformed because it is a strategic war metal. It is used in Tomahawk missiles, satellite tracking, and naval guidance systems. The market realized that a blockade in the Caribbean stops more than just oil. It freezes the global logistics network. If the US dollar is being weaponized to seize ships, then the dollar is no longer a safe place for China to store wealth. They are dumping treasuries and buying the rock. This incident is the kinetic spark that has turned a technical rally into a geopolitical super squeeze. You must understand that the $83 price in Shanghai is not driven by speculators or retail traders on social media. This is driven by industrial survival. The entities bidding silver to these extreme levels are solar panel manufacturers in Jiangsu and battery factories in Shenzhen. They represent the industrial heart of the second largest economy in the world, and they are terrified. These manufacturers are looking at their inventory levels for 2026 and 2027. They see a global mine supply that has been flatlining for a decade. They realize that if they do not secure the physical metal now at any price, their assembly lines will stop. For an industrial buyer, silver is price inelastic. If you are building a $50,000 electric vehicle that requires $80 worth of silver, you do not care if the price of that silver doubles. An increase to $160 is a rounding error for the final cost of the car, but the absence of that silver is existential. You cannot build the car without it. This is why the Chinese floor is so solid. Anything below $83 is seen as a bargain for a strategic asset that is running out. We are seeing data that silver imports into China via Hong Kong are spiking to record levels. They are effectively sucking the world dry of physical silver. While New York traders play with paper contracts, the East is securing the physical reality. This creates a massive, irresistible magnet that pulls the global price higher every single hour. While the geopolitical sparks fly, a colder and more powerful force is working on the charts. This is the physics of market structure. Technically speaking, silver has just done something it has not achieved in over 45 years. By closing above 74 Fe $50, silver has officially entered price discovery mode. In a normal market, price movement is a struggle. It encounters resistance, which is the memory of past pain. Resistance represents levels where people bought years ago and have been waiting to break even. But at $75, there are no bag holders. There is no memory of pain because every single person who has ever bought silver in history is now in a profit. When everyone is winning, nobody wants to sell. This is a seller's strike. This creates an environment of zero drag. Mathematically, it is now easier for silver to move from $75 to $100 than it was to move from $70 to $75. The friction of the atmosphere has vanished, and we are now in the vacuum of space. The high-frequency trading algorithms have undergone a regime change. For 10 years, these bots were programmed to sell the highs. But once a multi-decade ceiling is shattered, the command flips to momentum following. The logic is no longer to sell the expensive asset, but to buy high and sell higher. The robots are now chasing the vector of the ascent. They scan the order book, find it empty, and bid the price up in massive stair steps. 75, 78, 82. Each step becomes a new floor because there is no overhead supply to knock it back down. We must address the entities caught on the wrong side of this $83 reality. The bullion banks in London and New York are currently trapped in a nightmare. For years, they have managed the price by selling paper promises. They sold contracts at $68, $70, and $72. Now, with the physical price in China at $83, these banks are underwater on billions of dollars of notional exposure. Usually, their strategy is simple: dump massive amounts of paper shorts onto the market to crush sentiment and trigger a sell-off. But that weapon has been neutralized. If they artificially smash the New York price down to $70 while China is at $83, they make the arbitrage spread $13. They would effectively be paying the world to come and drain their remaining physical vaults. They are checkmated. They cannot suppress the price without losing their physical reserves, and they cannot let the price rise without suffering catastrophic losses on their short positions. This is causing a gamma squeeze in the options market. As the price rockets toward $80, market makers are forced to buy futures to hedge their risk. This creates a self-reinforcing loop. The higher the price goes, the more they must buy, which in turn pushes the price even higher. It is a death spiral for the banks and a rocket ship for the bulls. As we look toward the first week of January, the path is clear. The convergence between the paper markets of the West and the physical reality of the East is happening with violent speed. We are not just looking at a price increase, we are looking at the total repricing of a strategic asset in a world of conflict and scarcity. The move to $75 was just the opening act. The $8 gap with Shanghai remains a powerful vacuum that will pull New York higher the moment the full institutional desks return on January 2nd. With the United States military escalating tensions in the Caribbean and China, securing every ounce of silver they can find, the dollar is losing its grip as the ultimate store of value. Do not be fooled by the temptation to sell and take a small profit. This is the retail trap. Institutional money buys the breakout because they know that in a world of zero liquidity and high geopolitical risk, silver is the only exit door left. The move from $75 to $80 could happen in minutes. The move to $100 is now a matter of when, not if. Stay focused on the physical metal. Watch the spreads in Shanghai. And most importantly, do not let go of your position just as the rocket is leaving the atmosphere. The supercycle has begun, and the $100 wave is officially unstoppable.